Are you ready to learn the secrets of one of the most successful investors of all time? Benjamin Graham is widely regarded as the father of value investing, and his book, The Intelligent Investor, is considered a classic in the world of finance. But who is Benjamin Graham, and why is his work still relevant today? Benjamin Graham was a renowned economist, investment manager, and author who lived during the early to mid-20th century. He was a mentor to Warren Buffett, who often cites him as a major influence in his own investment strategies. In The Intelligent Investor, Graham lays out a framework for successful investing that emphasizes the importance of value, discipline, and patience. His principles are timeless and have been used by generations of investors to build wealth and manage risk. In this video, we're going to dive deep into the teachings of Benjamin Graham and explore the top takeaways from The Intelligent Investor. We'll discuss the importance of value investing, the role of patience and discipline, and how to apply these lessons to modern-day investing. So, whether you're a seasoned investor or just starting out, you're in for a treat. Get ready to learn the secrets of one of the greatest investors of all time, the importance of value investing. Are you ready to learn about one of the most powerful concepts in investing? It's time to talk about value investing. Value investing is a strategy that involves buying assets that are undervalued by the market. It's all about finding hidden gems that are overlooked by the masses and then holding on to them until they reach their true value. But why is value investing so important? Well, for starters, it's been proven to be one of the most effective ways to build wealth over the long term. Studies have shown that value investors have consistently outperformed the market, and that's no small feat. But it's not just about returns. Value investing also helps to manage risk. When you invest in undervalued assets, you're buying them at a discount, which means you have a built-in safety net in case the market takes a turn for the worst. So, where did the concept of value investing come from? Well, that's where Benjamin Graham comes in. He's widely considered the father of value investing, and his teachings on the topic have had a tremendous impact on the investment world. In The Intelligent Investor, Graham lays out a framework for value investing that emphasizes the importance of finding undervalued assets, understanding the relationship between price and value, and using financial analysis to make investment decisions. The importance of patience and discipline. When it comes to investing, it can be easy to get caught up in the hype and make impulsive decisions based on market trends. But as Benjamin Graham taught us, this is a recipe for disaster. Successful investing requires patience and discipline. So, what does it mean to be patient and disciplined in investing? Well, for starters, it means taking a long-term approach. Investing is not a get-rich-quick scheme. It's a marathon, not a sprint. By adopting a long-term perspective, you're more likely to make rational decisions and avoid being swayed by short-term market fluctuations. Being disciplined also means sticking to your investment plan and avoiding the temptation to make impulsive decisions. It's about having the self-control to resist the urge to chase the latest hot stock or to sell in a panic during a market downturn. In The Intelligent Investor, Benjamin Graham emphasizes the importance of patience and discipline in successful investing. He teaches us that by taking a long-term approach, remaining disciplined, and avoiding impulsive decisions, we can protect ourselves from the common mistakes that investors often make. The role of margin of safety. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. When it comes to investing, most people are familiar with the concept of risk and reward. But what if there was a way to manage risk while still maximizing returns? Enter the margin of safety. The margin of safety is the difference between the intrinsic value of an asset and its market price. It's the cushion that protects investors from downside risk. By investing in assets with a wide margin of safety, you're buying them at a discount, which means you have a built-in safety net in case the market takes a turn for the worse. But how do you determine the intrinsic value of an asset? That's where financial analysis comes in. By analyzing financial statements, you can estimate the true value of an asset and determine if it's undervalued by the market. Benjamin Graham, the father of value investing, emphasized the importance of margin of safety in the intelligent investor. He taught that by buying assets at a discount and with a margin of safety, investors can protect themselves from downside risk while still maximizing return. The importance of diversification. When it comes to investing, most people have heard the adage, don't put all your eggs in one basket. And that's exactly what diversification is all about, spreading your investments across a variety of assets to minimize risk. By diversifying your portfolio, you're spreading out your risk so that a downturn in one area of the market doesn't cripple your entire portfolio. It also allows you to take advantage of different market conditions and opportunities. But how do you diversify your portfolio? One way is to invest in a mix of stocks, bonds, real estate, and other assets. It's also important to diversify within each asset class by investing in a variety of companies or sectors. Benjamin Graham, the father of value investing, also emphasized the importance of diversification in the intelligent investor. He taught that diversification is crucial for managing risk in investing, and that investors should strive to spread their investments across a variety of assets to minimize risk. The relationship between price and value. Value investing is all about finding undervalued assets and buying them at a discount. But how do you determine if an asset is undervalued? The key is understanding the relationship between price and value. Price is what you pay for an asset, while value is what the asset is actually worth. By understanding the intrinsic value of an asset, you can determine if it's undervalued by the market. And when you buy an undervalued asset, you're getting a bargain, which means you have a greater chance for higher returns. But how do you determine the intrinsic value of an asset? That's where financial analysis comes in. By analyzing financial statements, you can estimate the true value of an asset and determine if it's undervalued by the market. Benjamin Graham, the father of value investing, emphasized the importance of understanding the relationship between price and value in the intelligent investor. He taught that by analyzing financial statements and understanding the intrinsic value of an asset, investors can identify undervalued assets and make better investment decisions. The role of financial statements and analysis. When it comes to investing, one of the most powerful tools at your disposal is financial analysis. By analyzing financial statements, you can gain a deep understanding of a company's financial health and performance. This information can then be used to make informed investment decisions. But where do you even begin with financial analysis? There are a variety of ratios and metrics that can be used to evaluate a company's performance, such as price to earnings ratio, price to earnings ratio, price to book ratio, and return on equity. However, it's not just about the numbers. It's also important to understand the company's story, the industry they operate in, and the broader economic context. Benjamin Graham, the father of value investing, emphasized the importance of financial statements and analysis in the intelligent investor. He taught that by analyzing financial statements, investors can gain a deep understanding of a company's financial health and performance and make better investment decisions. We've covered a lot of ground in this video, from the importance of value investing to the role of patience and discipline, and the power of financial statements and analysis. We've also discussed the concepts of margin of safety and diversification, which are important takeaways from the book. But it's not just about the concepts, it's also about applying them in the real world. By reading The Intelligent Investor and applying its lessons to your own investing strategies, you'll be well on your way to building wealth and managing risk. As Benjamin Graham said, the intelligent investor is a realist who sells to optimists and buys from pessimists. By following his teachings and being a value investor, you can take advantage of market inefficiencies and build wealth over the long term. But the journey doesn't end here. If you're ready to start improving your financial well-being, take action now. Check the first link in the description for our Frugal Living ebook. Our comprehensive guide covers everything you need to know about living a frugal and rewarding life, including creating a budget, identifying areas for cost-cutting, and finding affordable alternatives to everyday expenses. It's never too late to start making smart financial decisions.